So in this video, I wanted to talk about how you can play earnings with options, specifically selling options. And I want to take the example of Domino's Pizza. It's a trade that I made this week with earnings. It was a profitable trade. So I'm going to give that example. And then I'm going to talk about different trades that could have been made and ended up being profitable as well, and the risks involved with that type of trade, of course. So as you can see, October 13, Domino's Pizza was trading at $4.77. It was announcing earnings October 14 before market open. And if we go to October 14 on the chart, you can see here that it opened, or it reached a low of 461, but it actually went lower. So on 477, when it was trading at 477 October 13, the expected move, I calculated quickly just by looking at the money straddle. So basically what I do is look at the option chain, look up Domino's Pizza, and then I click on straddle over here. And then obviously market's closed right now, so I don't see anything. So let's keep it calls and puts. But I basically look at the value of the call plus the value of the put at the money. So at where the stock is currently trading at. So for example, right now Domino's Pizza is at 454. If I wanted to calculate the at the money straddle for October 22nd, it's trading at 455, let's say. So the expected move for next week, October 22nd, would be $5 plus $5 over here. So 567 plus 530. So it's about $10. That's the expected move. So going back to the chart here, Domino's Pizza, 5-day chart. So on October 13, when I looked at the expected move for October 15 expiry, which was the same week expiry, the expected move was 30 points. So 30 points with 2 days remaining. So that's because of earnings. So there's extra volatility because of earnings, the uncertainty of earnings. So with that high expected move, I ended up selling a put spread 30 points lower than the current market price. So if it was trading at 477. I did the trade a little bit earlier in the day actually. So 480, I did 480 minus 30. So I went at a short strike of 450. I did a put spread at 450, 445. So if I go to my account here, I guess orders executed, DPZ. So you could see here DPZ, put spread, vertical put, 450, 445. I collected $1. Now it wasn't even the best entry, could have collected more, but whatever. I went at a strike that's around expected move, so 450. Did a 5-point wide spread, collected $1, expiring the same week, so October 15 expiry. And then you could see the next, so you could see at the end here, October 13 opened. October 14, I closed it the next day at 9:31 a.m. So 1 minute into the market, I closed it for 10 cents. Now we saw that Domino's Pizza was trading at, it closed the week at 454. So it would have expired worthless, but definitely too close. Not worth the stress. So I like to close my earning trades if they end up showing profit. So open for $1, close for 10 cents. So that's $90 profit. That's with one contract. Anyone else could have done more contracts. Could have held to expire and let it expire worthless. But that's the trade that I made. So what I like about this trade is, if we go back to the chart, is I have no idea where the stock's going after earnings. No idea. But I like to give myself a good chance. So what I do is I go outside of expected move and I go on the put side. Why the put side? Because I don't know which direction it's going to go. I never know. I don't want to guess either or make assumptions. So I just pick a side that I notice wins more often. Why? So that's why I just stick to the put side. Why not do an iron condor? Why not sell the put spread and the call spread at the same time to be neutral? Because by doing an iron condor, I find that I am adding a restriction. I've got two restrictions now. The stock has to stay above 450 and has to stay below 510, for example. So I'm adding two restrictions. So I find it easier to just have one restriction to win on the trade. When I have a put spread at 450, 445, all I need for the stock to win is to stay anywhere above 450. So the stock can fly after earnings, can be flat after earnings, and can drop 30 points after earnings, and it will still make that $1 profit. Now in this situation, it dropped hard, but it was kind of weird because as you can see, it dropped hard and then came back up all the way up to 488. It was actually green after earnings, so it went up above the market price before earnings. But then on Friday, it just took a weird drop. Look at the end of the day here. Look at the end of the day here. It went from 469 and then dropped all the way down to 454 in like from 3 o'clock almost to 3:30. Just dropped hard. It really looks weird, but whatever. My put spread was a winner. That's why I like selling options, because I don't have to care about all this whatever this is called, whatever is going on over here. Stock goes down, goes up hard, and then all of a sudden drops hard at the end of the day. Makes absolutely no sense. So I don't have to worry about all that nonsense. I just pick a strike that's fairly out of the money, and I have a good chance that I win on the trade. Like I mentioned, it can go up, it can stay flat, and it could even drop 30 points and I can still win. In this case, it dropped and I ended up winning on this trade. Now, what would I have done if I had dropped way below my strike? So what if I had dropped to 430, for example? So then this trade would be a loser. My max loss is $4, but I probably would have rolled it. I would have had to roll it by increasing the contract. So I initially had a 1 contract size. So if I go back to option account executed, so you can see DPZ over here, it's one contract, 454.45. So if Domino's Pizza would have dropped below 445, which is unlikely, but it's still possible. If that would have happened, I would have just rolled the whole trade. Either I accept to take max loss for $4, or I try to roll the whole trade by selling an extra contract and lowering the strike. So how I would do that, I have a video where I explain how to how I manage my put spreads. So it's this video here, how I manage put spreads and naked puts. Now the other trade I was thinking of making, but I never dared to do it, is selling a short straddle. So selling the call and selling the put at the money. So when Domino's Pizza was trading at 480, sell the 480 put and sell the 480 call. Now obviously it's going to take more capital to place this trade, but I would collect 30 points. I would collect $3,000 with that trade. And now all I need after earnings is for the stock to stay within 30 points on each side. So I would need the stock to stay between 450 and 510 for me to win on this trade. Now if I had done this short straddle and held till expiry, which it expired at 455, that means my short straddle would be worth $25. So I sold for 30, I'd buy back for 25, so my profit would have been $5, which is $500 in this case, in this scenario. But if I didn't hold to expiry and I just closed it midday, for example, on the next day, you could see that it was trading at 486. Now at that point, I'm not sure what the options were worth, what the call and the put was worth, but let's say it was worth about $15 because it still had a day of expiry. Then that would have given me a $15 profit because I would close the short straddle for 15 and I initially opened it for 30. So that's a $15 profit or $1,500 with 1 contract. Now the risk, of course, with this trade is if the stock flies or even the stock drops. Although if the stock drops, you can probably roll it as a naked put. But if the stock flies, then you're in trouble. It happened if you had done this trade. If I had done the short straddle, for example, on Zoom, there was an earnings where Zoom flew. Let's see if I can find it here. So let's look at the 3-year chart. I probably don't need to go that far, but it's when the stock went from like 350 to 4. Yeah, there we go. So if you look up here, look at this. The stock opened at 304 but had a high of 478. Let's look at the day before. Actually, earnings is over here. Okay, so the day before, the stock closed at 299. The next day it opened at 304, but it had a high of 478. So if someone had done a short straddle on earnings, here I changed the layout of the chart so it's more obvious now. I changed it to daily candlesticks. So you can see here the stock closed at 325 August 31st, and then September 1st the stock opened at 439 and had a high of 478. So if you had done a short straddle here when the stock was at 325, I don't remember what it was worth, but let's say it was worth maybe 40 points. Might be a little bit generous, but let's say it was worth 40 points, the expected move. So you would have, I remember I did a put spread that earnings, and it was obviously a winner because the stock flew. And I think my put spread was probably 30 points lower. So I'm going to say it was 30 points. So the expected move was 30 points. So the short straddle would have given you $30 or $30. So $3,000 that you get credited into your account, or $30 for one contract. And then the next day, so that means your break even on the call side is 325 plus 30. So your break even is 355. Stock opens at 440. So what is that? 440 minus 355 is almost $95. So just at the open, you're down $95 at least, just in intrinsic value. And then the stock goes to a high of 478. So you're actually down on the call side. You're down 478 minus 355. You're down $123. So if you had done one contract, you're down $12,300 if you had done a short straddle for earnings on Zoom that day. Now, if you had held to expiry, I think it was September 2nd expiry, or wasn't that far. September 1st, September 2nd, September 2nd, September 3rd, 4th. Okay, so it had a September 4th expiry. You could see that it closed at 369. So if you had held to expiry, this short straddle, you would have still lost, but much, much less. But if you had tried to close your short straddle right after earnings, you would have lost at least $12,000. But if you had held to expiry, it closed at 370. Your break even, remember, is 355. So you would have lost $1,500 in this situation. Now, I don't know what the right answer is. If you do a short straddle, do you hold till expiry, or do you close right after earnings? Now you could see in this example, it was better to hold until expiry. In the Domino's Pizza example, it was better to close right away. You would have made $15 profit instead of just $5 profit. But let's go back to Domino's Pizza here. I'm going to try to find the value of the options. So if I look up DPZ option chain, the problem is that they expired, so I'm not going to be able to see the October 15 options, or the value of the options, because they're no longer there. I only have October 22nd. But I remember looking at it, and the straddle was $30 before earnings, and after earnings it was around $15. And if you had held to expiry, it would have been around $25. So you would have made profit either way. But that's another way of playing earnings, but it's very risky. As you saw in the example of Zoom, you would have lost a lot of money in that example. Another trade you could have done if you had the buying power is probably just sell a naked put out of the money before earnings. So if I go back to the chart here on Domino's Pizza, it was trading at around 475, 480, but you could have sold a naked put at around 430 for $1. So you would have gone even outside of expected move. You would have gone 50 points below the market price to collect $1. And it would have been an easy winner, of course. As you can see, after earnings, even after dropping 30 points, it was still outside. It still did not reach 430. It would have been an easy winner, even with the craziness on Friday. Let me just see what happened after hours. I think it dropped. I think after, look at this red candlestick here on Domino's Pizza. So this candlestick here, I'm looking at the 5 minutes. Yeah, okay, whatever. So this candlestick here, you can see it had a low of 445. So Domino's Pizza after hours, or before market open, it actually dropped all the way down to 445. So my put spread was breached at some point, completely breached. But then when the market opened, it just was 9:30 would be the market open. So over here, it opened at 461. So I'm looking over here. So when the market opened on October 14 for Domino's Pizza, it opened at 461. It dropped to 455.96. So my put spread during market hours never got breached, but it came pretty close. And then it closed at 461. And yeah, so that I was able to close this trade at around 9:31 actually for 10 cents. Yeah, so that's how I played earnings on Domino's Pizza. And I just want to share that there is another way to play it, much, much riskier though, but it is rewarding when it does work out. And also, This is probably most likely how I'm going to play the rest of the earnings season. Either it's going to be an out of the money naked put if I can afford a naked put on the stock, or it's going to be an out of the money put spread, and only when the expected move is decent. I mean, 30 points on a $470 stock seemed like pretty far, so I had to take that trade. All right, so if you have any questions, leave in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. Thanks for watching.